Hashtag the 2008 housing crisis explained. What really happened? Imagine waking up one morning to find that your home, the single largest investment of your entire life, is now worth less than what you owe on it. Imagine watching your neighbors pack up and leave, one by one, as foreclosure signs replace welcome mats across your street. This wasn't a nightmare. This was the daily reality for millions of American families between 2007 and 2010. The 2008 housing crisis didn't just crash the real estate market, it triggered the worst global financial collapse since the Great Depression. But here's the question nobody fully answers: how did the most powerful economy on earth let this happen? Today, we're going to break it down completely: the causes, the players, the warning signs that were ignored, and the devastating consequences that reshaped real estate forever. To understand the crash, you have to understand what came before it. Throughout the 1990s, the American economy was booming. The stock market was soaring, employment was strong, and homeownership was seen as the ultimate symbol of the American dream. The federal government actively encouraged this. In 1995, the Clinton administration expanded the Community Reinvestment Act, pushing banks to lend more aggressively to lower-income borrowers. In 1999, Congress passed the Gramm-Leach-Bliley Act, which effectively repealed key provisions of the Glass-Steagall Act, a Depression-era law that had long separated commercial banking from investment banking. This single legislative change opened a floodgate that would take nearly a decade to fully burst. Then came the dot-com bust in 2000. After the tech bubble collapsed, the Federal Reserve, led by Alan Greenspan, dramatically slashed interest rates to stimulate the economy. By 2003, the federal funds rate had dropped to just 1%, a historically low number. Cheap money flooded the system. Borrowing became almost effortless. And investors, burned by the stock market crash, began looking for a new place to park their money. Real estate looked like the perfect answer. Property values had been steadily climbing for decades, and the conventional wisdom of the time was ironclad: home prices never go down nationally. That belief would prove catastrophically wrong. With interest rates at rock bottom, mortgage lending exploded. Banks and mortgage companies began issuing loans at a pace never seen before. Between 2003 and 2006, mortgage originations in the United States totaled over $11 trillion. But as the pool of qualified borrowers dried up, lenders didn't slow down, they changed the rules. This is where the story takes a genuinely sinister turn. Lenders began offering what became known as subprime mortgages. These were home loans extended to borrowers with poor credit histories, unstable incomes, or no verifiable assets. Products with names like Ninja Loans, No Income, No Job, No Assets, became standard practice. Adjustable rate mortgages, or ARMs, were sold with teaser rates as low as 1 or 2%, knowing full well that when those rates reset in 2 or 3 years, many borrowers simply could not afford the new payments. Mortgage brokers, who earned their commissions the moment a loan closed regardless of whether it was ever repaid, had every incentive to push as many loans as possible. Appraisers, pressured by lenders, routinely inflated property values to justify larger loan amounts. The entire origination process had been fundamentally corrupted by misaligned incentives. But the real engine driving all of this wasn't the mortgage companies themselves, it was Wall Street. Here's how the machine worked. Banks and mortgage lenders didn't want to hold these risky loans on their own balance sheets for 30 years. Instead, they sold them to large investment banks, firms like Bear Stearns, Lehman Brothers, and Goldman Sachs. These banks then bundled thousands of individual mortgages together into complex financial instruments called mortgage-backed securities, or MBS. They then sliced these bundles into different tranches, or layers, of risk and sold them to investors worldwide. The top tranches were supposedly safe. The bottom ones were high risk, high reward. Credit rating agencies like Moody's and Standard & Poor's gave the vast majority of these securities their highest possible rating, AAA. The same rating given to United States government bonds. Why would rating agencies do this? Because they were paid by the very banks whose products they were rating. This conflict of interest was breathtaking in its scale. Investors, pension funds, insurance companies, foreign governments trusted those AAA ratings and bought these securities by the trillions. And then, Wall Street invented something even more complex: collateralized debt obligations, or CDOs. CDOs were essentially bundles of the riskiest slices of mortgage-backed securities, repackaged and re-rated as safe investments. This was financial alchemy at its most dangerous, and almost nobody on the outside understood what was actually inside these instruments. By 2005 and 2006, home prices across the United States had reached extraordinary levels. In cities like Las Vegas, Phoenix, Miami, and across California, prices had doubled and even tripled in less than 5 years. Median home prices in some California markets exceeded $500,000, while median household incomes had barely moved. The gap between what homes cost and what people actually earned had never been wider. Speculators were flipping houses for massive profits. Construction was booming. Everyone, it seemed, was getting rich. But the cracks were already forming. By late 2006, home price appreciation had begun to slow in many markets. Inventory was rising as new construction flooded the market. And then, in 2007, the adjustable rate mortgages that had been originated 2 and 3 years earlier began to reset. Monthly payments on homes jumped by hundreds, sometimes thousands, of dollars overnight. Borrowers who had been barely managing their teaser rates suddenly faced payments they had no hope of meeting. Delinquencies began to spike. Foreclosures started climbing. In February 2007, HSBC, one of the world's largest banks, announced massive losses in its American subprime mortgage division. In June 2007, two Bear Stearns hedge funds that had invested heavily in CDOs effectively collapsed, losing nearly all of their value. These were early tremors before the earthquake. Throughout 2007, more cracks appeared. Countrywide Financial, at the time the largest mortgage lender in the United States, was hemorrhaging losses. New Century Financial, a major subprime lender, filed for bankruptcy in April 2007. By early 2008, it was clear that the financial system was in serious distress. In March 2008, the Federal Reserve orchestrated an emergency rescue of Bear Stearns, facilitating its sale to J.P. Morgan Chase for a mere $2 per share, a company that had traded at $170 per share just a year before. But the defining moment came on September 15, 2008. Lehman Brothers, a 158-year-old institution with over $600 billion in assets, filed for the largest bankruptcy in American history. The shockwave was instantaneous and global. Credit markets froze. Banks refused to lend to each other. The financial system came within hours of a complete collapse. The government's response was extraordinary in its scale. The Troubled Asset Relief Program, known as TARP, authorized $700 billion to stabilize financial institutions. The federal government took control of mortgage giants Fannie Mae and Freddie Mac, which together guaranteed roughly half of all American mortgages. The Federal Reserve launched unprecedented interventions, purchasing toxic assets and slashing interest rates to near zero. Despite all of this, the damage was already done. Between 2007 and 2012, approximately 6 million American families lost their homes to foreclosure. Home prices nationally fell by an average of 33% from their peak. In the hardest hit markets, prices dropped by 50, 60, and even 70%. 8 million jobs were lost. The stock market lost approximately 50% of its value. Global GDP contracted for the first time since World War II. Retirement accounts were wiped out. Communities were devastated. The ripple effects touched virtually every corner of the economy and every nation on Earth. So what did we actually learn? The Dodd-Frank Wall Street Reform and Consumer Protection Act, signed into law in 2010, attempted to address many of the regulatory failures that enabled the crisis. It created the Consumer Financial Protection Bureau, imposed stricter lending standards, and attempted to regulate the derivatives market more transparently. Mortgage standards tightened dramatically. The days of ninja loans were over, at least officially.